What if the money you thought was invisible is actually being watched? Imagine this. A man sits in front of his laptop. Multiple tabs are open on his screen. A crypto wallet, an exchange account, and a spreadsheet where he's calculating his profits. There's a slight smile on his face. This income might escape the tax system. But what he doesn't realize is the world is changing, and governments are no longer just tracking banks. They're now tracking crypto transactions too. What once felt anonymous is slowly becoming transparent. So the real question is crypto still safe for hiding income? Or has a new crackdown already begun? When cryptocurrency first became popular, it was known for one thing: freedom, no banks, no central authority, no middlemen. People believed they finally had full control over their money, but along with that freedom, some began using it for hidden income, tax avoidance, cross-border transfers. But that story doesn't end there. The concern for governments is simple: revenue loss. If people don't declare their income, the entire tax system weakens. And when billions of dollars are moving through crypto, authorities can't ignore it anymore. That's why regions like the United States and Europe have started taking crypto much more seriously. Today, crypto isn't as anonymous as many believe. Blockchain is a public ledger. Every transaction is recorded, and with advanced tools, authorities can now track wallet activity, analyze transaction patterns, identify suspicious behavior. In other words, a system built for transparency. It is now becoming a powerful investigation tool. In the United States, regulatory agencies have significantly increased crypto monitoring. Tax authorities have made one thing very clear: if you earn profits through crypto, they are taxable, and if you fail to report them, you could face penalties, fines, or even legal action. Crypto exchanges are also under pressure. They are now required to share user data, report transactions, follow strict compliance rules. What was once optional is now standard practice. Europe is not far behind. Many European countries have introduced stricter regulations, including cross-border data sharing, mandatory transaction reporting, anti-money laundering laws. The goal is clear: bring crypto into the formal financial system and reduce illegal activity. There was a time when people believed crypto, anonymous money. But today's reality is very different. If you use centralized exchanges, your identity is already linked. If you move funds, there's a transaction trail. And if authorities investigate, patterns can be traced. Which means the idea of hidden income is no longer as simple as it once seemed. In recent years, several high-profile cases have emerged. Individuals have been penalized for crypto-related tax evasion. The consequences? Heavy fines, legal charges, in some cases, even jail time. These cases send a strong message: governments are serious now. Crypto exchanges are no longer just trading platforms. They are now part of the regulatory system. They must follow KYC, know your customer rules, transaction monitoring, reporting requirements. If they fail to comply, they risk bans or restrictions. That's why most major exchanges are now aligning with regulations. This has sparked a major debate. Some argue crypto was created for privacy and decentralization. If everything becomes regulated, what remains of its original vision? On the other hand, governments argue regulation is necessary to prevent fraud and illegal activity. So this becomes a battle: privacy versus control. If you're a crypto investor, these changes matter. You need to track your transactions properly, understand tax obligations, stay compliant with regulations, because in the future, audits and checks could become even stricter. Looking ahead, several trends are likely: stronger global coordination, standardized tax frameworks, more advanced tracking technologies, the rise of central bank digital currencies. The crypto ecosystem is becoming more structured. If we zoom out, this isn't just about crypto. It's about the evolution of the digital economy. Governments are adapting. New systems are being built, all to maintain financial oversight in a rapidly changing world. Rules are becoming stricter. Transparency is increasing. So the real question isn't whether crypto will survive. It's this: what will crypto become? Completely free, fully regulated, or something in between? One thing is certain: the era of digital money has arrived. But now, it's being watched more closely than ever.